If you have not signed up for advising through SBDC, you're not showing up on the attendance list. Yeah. So you signed up for the class, which actually registers you with the college. But SBDC is the one that's putting on the class. And I say that because, and they'll agree, but the two systems don't talk to each other. So we have to do one thing over here, they do one thing over there, and then we go back and forth. So if I could have you log on to the SBDC, Tillamook Bay SBDC, it has a little button that says, you know, click for advising or something like that, sign up, and then Riddell will make the connection.
Where do you SBDC?
Oh, and I was going to tell you.
Is Maria on the list?
Yes. So I have Megan, Sam, Maria, Jamie, Riddell, Cynthia, and Jennifer. If you have not, but if I just read your name off, you are, right? Nope. Christine, you are on advising. Just let Riddell know that you just need to be connected. Or is Riddell, are you writing all this down?
No, not yet.
Okay.
I can.
So Cynthia, or Christine Soto is already in advising.
Christine Soto.
And then Jeremy will go do it. Cynthia's on. Everybody else, I think, is on. Vicky Mata actually is already an advising client, so you should be able to connect her.
Like I said, Cynthia, Vicky, you said, or sorry, Soto and Mata, and you said Jeremy?
Jeremy, she's going to register.
Oh, okay.
Harmony, sorry.
Harmony? Okay.
They're gonna not allow me to talk. I'll say.
What's the last name for Harmony?
Purple. Very sweet lady, does carpet cleaning.
Oh, okay, yeah, I remember now.
And I'll have it figured out. Charmony.
Charmony, okay.
Oh, you guys, it's one of my weaknesses, I will say. Okay. So I have to stand right here the whole time. Okay. So is that better?
Yes.
Thank you. All right. So, Maria, just so that you know, it wasn't us that couldn't get this whole setup going. There's something wrong in the box. And so Nicole and Tom were here for 2 hours.
Okay.
So, yes. So Riddell, I don't know if they put the key back in your desk, but the key's not supposed to be left down here in this. But yes, this system is not working. So that's why I'm tied to this laptop, except for I have this one for a visual and you're listening through the speakers.
Wow.
And if you see me do this, it's because I'm going in and out. Hoy. Hey, we got to laugh. It's laugh or cry. But I'm thankful that they got it fixed. All right. So I've had some feedback. One to four, correct? We did 1 to 4. Maybe, maybe not. Okay. And are you being graded on this? No. Nobody is being graded on this. However, if you would like to get Pro Advisor certified status by the end of the 10 weeks, you'll go through that to get certified. But if you're doing this just for your business and for your personal growth, don't sweat it. What I would do is take the quiz, and if you get, 60, 70%, you might go, oh, maybe I should look at it. If you get 80, I'd call it good and move on. That's just me personally, because there is no way you're going to memorize all of this, but you're going to have your materials for reference. And there may be some things that you do one time a year. And if you're like me, you're not going to remember that. You're going to have to go look it up.
Is that something you can adjust? We can check,
Yeah. So,
I mean, you have so many to go through, and it's nice to know at the beginning if you have concepts.
So I have a teacher's assistant that I will have look at that for me, because no, that's not you. I have you for the technical here, and I have a teacher's assistant to do the other stuff, because it's going to be all I can do to talk up here and try to get all of those things going at the same time. So Jenny's working on the teacher assistant stuff. What Megan asked is if we could have multiple times for, more than just 2 times to check the work. So it's a setting that apparently the instructor can put on.
Because let's say you have maybe 10 problems to solve within a whole thing, and you go check your work, and it will show which ones you got right and which ones you got wrong. And then you redo the wrong ones, and let's say you still have one wrong, you can't go check it again to make sure you actually have that.
Okay.
Yeah, that makes sense.
So at least 3 or 4.
Or unlimited. I would prefer unlimited.
Okay, we'll see if unlimited is an option. The other thing on the feedback that came through was that you guys might like some lab time beforehand. So I will start being here at 4:30. And if you guys want to come and work for an hour before class starts, I know sometimes it's hard enough to be here at 5:30, but if you want to come and you want to just sit and work, and if you have questions, we'll help. I'll help and answer those questions. If it's something that you need, even, just 5 minutes afterwards, just let me know. This is all about making life easy for you guys, not about, and it's easier, if you've got me here, right, to ask those questions. So, how did you feel about what you've done so far? Even if it's just number 1. Stressed, okay. Stressed because you didn't feel like you knew it at all, or okay. All right.
Slightly different.
Okay. So one of the things that I want to talk about tonight as we get started, I want to review 1 through 4, and we'll stop where we need to. But I also want to talk about what's normal for a bookkeeper and what's normal for an accountant or a CPA. Because some of the terms and some of the concepts that you're learning should not be things you guys are doing in everyday business. What you're actually looking at is you should be doing your income and your expenses. Other than that historical, a lot of the other information is going to happen when you work with your CPA. Okay. So unless you go out and buy a building, or you go out and, that's when for all intents and purposes, the CPA needs to come into play, because it's a really large purchase. It needs to be depreciated. And there's certain things that happen with taxes that they know, and you don't care. That's what you pay them for, right? If you buy a vehicle, any one of those things, that's where you rely on them. So it was interesting, because I've had a couple of conversations this week, and it was, how do you know that? So I'm old, and I've been around a lot of where I've had the accountants give me the journal entries to then put in. So, you know, to bring the year up and correct it. And I just go in and I put it in just exactly like they do it. I don't ask any questions. I just put it in. The books are brought up to date. They match the taxes and on I go. That's the only reason that I know these. It's not because I have some special skill. I do not want to do taxes, have chosen not to do taxes. So I purposely stay out of that. So I'm going to hand out papers, so I'm going to leave. Stand right in front of the mic. Is that just one over there?
And Terry, I think one thing that got me a little bit caught up was like the adjusting journal entries for like the deferred expense. So like you had the prepaid insurance, like, and then going and doing that journal entry every month, which I think I need to ask you about that. Wait, Terry, did I ask you about that?
Yeah. So, Megan's question was about deferred, revenue expenses, and it actually does work for revenue too. And, how do you know if that applies to you or not? There's sometimes like security deposits or some of those things. That tends to be more accrual accounting, and we're going to talk about that tonight. Cash accounting, and is, I bought it and I walked out the door with it and our transaction is done. Now I buy insurance and that insurance is supposed to cover me for the 12 months, right? It used to be that the accountants would have you put it in prepaid and then every month do a journal entry until you quote used it. Nobody does it that way. It's understood. I bought my insurance to cover me for a year. Yes, it's prepaid, but I'm not gonna, no. So if you're in a situation where you're, let's say you're a landlord and you have a security deposit that when the person moves out, you're gonna refund the security deposit, that you do have to record on the books. And the reason for that is you have to keep that, let's say it's $500, you have to keep that $500 available to pay them, right? You can't spend it and then when they come and they say, I'm moving out, I want my deposit back, and you go, oh, you're gonna have to wait because, and Peggy, you probably know this, is there a time limit on how quickly? 30 days? Okay. And I know oftentimes, because this comes up with employees, if they quit or resign, you do not have to give them their check right away. If you fire them, you have to have the check ready by end of day. So that's part of it. That's where some of those things are coming into play. All right, so let's go and start with our review. The accounting cycle. Anybody have questions on the accounting cycle? Did that make sense? What's funny is the record and post journal entries, I think, should be at the end of the year. But I would tend to, and we might just remake this for us by the time that we're done and say what it actually looks like for us in our small business versus the theory. The accounting equation, assets equals liabilities plus owner's equity. Okay. That accounting equation also ties to the balance sheet. You're going to have assets on one side, you're going to have liabilities and equities on the other. Common accounts. So when we talk about assets, we're talking about cash, accounts receivable, supplies, the prepaid insurance, merchandise inventory. If I own a boutique or I own something where I have inventory, then that is considered an asset until it is sold. Equipment, buildings, and land. And then my liabilities are accounts payable, notes payable, which are basically loans, salaries payable, unearned revenue, and mortgage payable. Somebody just went by, I don't know who it was. Owner's equity, sales revenue, service revenue, rent expense, utility expense, telephone expense, and then John Doe Capital and John Doe Drawing. That, and we'll look at it when we go through. I put the penny game on for Peggy. At the very end, this is actually called net income. You'll see net income in the capital in the drawing. We don't show it that way. When Leon and I were talking about it, it's almost like they cut the globe in half and laid it flat. That's how they're trying to show that to you. That's not necessarily how you would see it normally. Okay, evaluating transactions. Number one, we have to determine which accounts are impacted. And here's the discussion that was going on, right? Does it increase or does it decrease? And by how much each account is impacted. So what you're looking at on that, we talked last week a lot about I'm recording history, right? So when I look at my step one, which accounts are affected, if I wrote a check, where's it coming from? Somebody. From cash, right? It's coming out of my checking account. If I go and I swipe a card, where is it coming from? Right. So if it's a debit, it's coming out of my checking account. If it's a credit card, I now have a liability because I have to pay the credit card. So that's what you're looking at there is does it increase? Does it decrease? Which account is it? The thing with it, if you do a credit card, you got 30 days to pay it. If it's a debit card, it comes out of your checking account right away, correct? That's how that's part of that. How is it impacted? Okay. You guys stop me if you have questions. Because this is review from week one. We talked about if I put cash and service revenue accounts are impacted, both accounts have increased. And then step three, both accounts are impacted by 850. So we put the 850 in the cash, right, account, and then owner's equity. So that could be that first deposit that we put in to start the business, or it's our first sale. But we're showing income and we're showing it's in owner's equity. He sold 850 donuts for $1 each. And now we're talking about ending balances. This is the recording. And so we're showing the in and out of every transaction. And this is how you would see it in the computer, in the program, or on your reports. It'll show in your profit and loss as income in and out, and then assets and liabilities will show on your balance sheet. We talked about the generally accepted accounting principles, and that is nationwide, worldwide. And we talk about the cost principle. It must be recorded at the amount paid for the item. So if I buy something, and this one's funny. I go to a garage sale and I pick up a really good table saw for $5. But had I have gone to Home Depot and bought it, it would have cost me $500. I cannot put it on my books at $500. I have to put it at $5.
What if you already owned it and lost receipt for it?
So oftentimes what happens is, like, even let's say I owned it and I started my business and I want to pull it into my business, it's a fair market value at the time I book it into my business. Or depreciated market value of it at that point. Revenue principle is revenue must be recorded in the period in which it is earned. This one kind of is funny because credit cards right now, you may do a credit card transaction on the 30th, but it doesn't hit the bank account. Let's say the 30th is a Friday, it doesn't hit the bank account till Monday, which is a new month. So you have to be careful of how you're capturing that revenue. Same thing, that matching principle, expenses must be recorded in the same period as the revenue they generated. It's pretty, again, we're doing historical. If I bought it in January and I expensed it in January, everything should be happening in January. I shouldn't be putting it somewhere else. The monetary unit principle, that's gonna be, am I using US dollars? Am I using euros? What am I using? So let's say if I go, even Mexico is pesos, and I pay for it with pesos, I have to then translate it into US dollars for the value that it was on that day. Because typically when you're in Europe, you're in Mexico, it could be changing daily, sometimes hourly, it feels like. And so you have to know what it is. When I was in Europe, I know that they would have me wait until it cleared the credit card, because that's where we found out that dollar match or the dollar value on that, because then it would show up at, this is what the credit card company got it for. And then full disclosure principle is about public companies. So think about the companies that are stock exchange, right? They're public. And so if you've got stocks or shares in anything, Edward Jones, any of those, and you get those shareholder reports, that's what that is. And then nonprofits are also under that. So if I donate to a nonprofit, I have the right to know how they spent the money. And then what happens if you have errors? It's called life. It happens every day. And so in this one, such as 250 instead of 520, you forget to put something in. You can either do it by journal entry, or, and this used to be the thing, is when you closed a month, you closed the month. And so if you did anything back into that month, you had to reopen your month. QuickBooks does not do that. It allows you to just fix it. And at the end of the year, when you close your year, because most people are working through really about a 6-week period, right? So I would be closing and unclosing all the time. So at the end of the year, I will close. And then if I go to do something, it'll go, your books are closed. Are you really sure? And this is where we've talked about in class. If they ask you if you're really sure, don't say yes. Call someone. So, and they're asking you that because then the proper way to do it would be for you to do journal entry to put it into the closed period. Okay. It's really a big deal if you're a publicly traded company, if you're a nonprofit, if you're in some of these other situations where what's happening is your books are being audited and they need to follow the audit trail. If you're not the audit person or being audited, there's not going to be anybody over the, with a big stick waiting to hit you over the head if you did it wrong. I know it feels that way. And the other thing is you may have accountants who like it this way, and then this other accountant likes it this way. And so it doesn't mean that it's wrong. It's just some people have preferences. Accrual basis of accounting is revenues are recorded when they're earned, regardless of when the cash changes hands. And so that, when we talked about it, so the creamery is the biggest business we have around here, right? Especially with inventory. But let's say Winco or Costco places an order for 50,000 pounds of cheese. They're paying for it before it's shipped over. So that's where the accrual comes in, is that we made the sale, we're invoicing you, you're paying for it. It doesn't matter when the cash actually changes hands or when the product even changes hands. And then
I don't know if it makes sense, but I want to ask you. So if I have it like in December, he works in December. He didn't get a W-4 until next year.
no. So if he worked in December and you pay in January, then that's where it's talking about, okay, so let me say it this way. If last year, so the previous year, you paid his December and January, so he had 12 paychecks that are showing up on his W-2, then it stays that he gets paid. So his first check in January is actually for the hours that he worked in December, but that follows suit every year. Because a lot of people that work on or pay once a month, they pay on the 5th of the next month because they want to capture all 30 days. So as long as whatever you do the first time stays the same, they will have 12 paychecks on their W-2. And then expenses are recorded when they're incurred, again, regardless of when cash changes hands. It's compliant with the GAAP accounting, and this one is the one that uses the most journal entries because it's going back and forth and moving things to the period or making adjustment if it needs to. This one, yep.
Yes, I want to apply to my business.
Okay.
He made a commitment to paint the house in 2024.
Mm-hmm.
Made that commitment October 2023.
Okay.
Got a 1/4 deposit
Mm-hmm.
that went in as money coming in 2023.
Okay.
And so, if we get the rest of the work in June,
Right.
so how does that work?
So that revenue is a deposit.
It's a deposit, yes.
That is not, right, and that is not sales income. So that would actually be considered a deposit. That could be a prepaid deposit. So the question that I would have is it refundable? So then it should be a liability on your books, right? Because they could cancel. If it's a non-refundable deposit, then you recognize it as cash when it came in.
I don't count it for taxes.
No, you're right. What the statement you said is right. You should not.
But your client's gonna claim it.
If they're sending you a 1099, but you're showing it on your books as a deposit because it's a refundable deposit. So she's showing it on her books. She's not showing it as income. She's showing it as a deposit.
So what happened?
No, not if you're doing it right. Yeah, they shouldn't be sending you a 1099. You haven't done the service. Well, and that's fine. They can dump all the money they want. Well, and that's fine, but are you giving them a refundable deposit or are you counting it as income? Then you're counting it as income. Yeah, that's the difference, right? If it's refundable, I can't count it as income. If it's income, I count it as income. They just paid in advance for it, but they're not getting it back. Those are the two key differences. Anybody else make sense? Anybody else question? Hopefully that made sense. Okay. Now we're going to go cash basis of accounting. Revenues are recorded when cash changes hands regardless of when they are earned. That just answered your question, right? They paid me. It's a done deal. Our transaction is done. Expenses are recorded when cash changes hands regardless of when they are incurred. This again, I go into Rosenberg's, I want to spend some money before, so I don't have to pay taxes on it, but I may not get the product until, right? I'm going to order a pallet of whatever. I'm not going to get the product until after the, in January at whatever point, or February, but I paid for it in December. I expense it in December. And then this accounting basis, it says is not compliant with GAAP and eliminates the need for adjusting entries. What's really funny is we all live in this quasi world where we do a little bit of both. And so we are following all of the standards, and QuickBooks is set up to follow the standards. So there's not anything that you're going to do that's going to throw you out of compliance. It's that it's hard for me as a business owner so I invoice my customers after I do the work. So it's hard for me to be accrual and cash 100% either way. So I'm a little bit of both. That's where the compliance comes in. And as long as we're recording it the way that we should, we are in compliance. I love when that word not, like, yes, it is. It says so on my tax document when I click that for the IRS. Financial statements. This displays ending balances of all revenue and expense accounts. So income statement is the same as a profit and loss. They are the same thing, called two different things. They are exactly the same thing. P&L and the income statement shows all the money I made for the month and all of the expenses.
Wait, one more time, you can say my sister.
Is the P&L profit and loss?
Thank you.
They're the same. Statement of owner's equity and the balance sheet basically are the same thing, because the only time that the owner's equity comes in or shows up on the report is with a balance sheet. It does not show up on your income statement. And then the statement of cash flows is going to show you how much money you have projected to come in and how much money you have projected to go out. What is key with the cash flow is if you don't use your accounts receivable and accounts payable features, which if I'm a cash only business, right, and I'm putting in income as it comes in and I'm putting expenses as they come out, I'm not going to have a statement of cash flow because it's what's happening every day, real time. But if I'm invoicing and I say, I've invoiced and by the 10th of the month, I'm expecting to get $10,000. That's where the cash flow comes in. And also, if I'm using accounts payable and I have an account with Coast Printing, and I can go down and you know, Rosenberg's, and I can go down and buy supplies and everything else, they send me a bill. And quite frankly, my credit cards, right? Because I got 30 days to pay. That's where my cash flow is going to show, is that on this date and time, I have to pay this amount. But if I don't use that, I'm not going to ever see. So a lot of really like small businesses, daily transactions, you're not going to state a statement of cash flows. It's going to be larger businesses that are doing accounts payable and accounts receivable on a daily basis. So if you're like, I've never seen a cash flow statement, not unusual. So who uses financial statements? You've got the internal workers, or the people that work within the company. And external are people, obviously, that work outside the company. Potential investors, government agencies is a nice way to say the IRS, state of Oregon, or, you know, wherever. And then potential lenders, right? And they're going to look at the profit and loss or the income statement and the balance sheet. So they're looking at, and if you are using it, they're going to want to look at the cash flow. And what they're wanting to tell is what is the health of your business. And so when we get kind of to the end of tonight, we'll play a little bit, which, by the way, I spoke with Miss Nora last night, and I'm supposed to tell you guys that I have permission to share her stories with you, and that when we get to the penny game, you're supposed to pay grandma first. We did the penny game with her, and she was so upset because they didn't pay grandma first. And then grandma made a cake, and I go, that's why they didn't pay grandma first, because grandma keeps baking cakes. But anyhow, it was cute. She said, yes, you tell them. I'm like, okay. Permanent accounts. So this is the permanent, I'm fighting going over and writing on the board because then you can't see in here. The ending balance for 1 year becomes the beginning balance for the subsequent year. So when we talk about the profit and loss, right? And that is January, February, March, April. At the end of the year, I close my year. January 1, I start all of the revenue accounts and all of the expense accounts start at 0. I've closed my books. It moves completely over to the balance sheet. And that is the value of my business on day 1 of January 1st should be the same as it was on the close of December 31st. If there's any changes that come into play during those, that would be where the CPA or an auditor would come in and say, we need to fix some things. You bought a truck and you didn't do XYZ right. We need to fix it. That's the only time that you would ever have those adjusting entries. Otherwise, it should be what I ended my year with and what I started my year with on those balances should be the same.
With us, because we pay retainage.
Mhm.
So we always have that 5% hanging out there until the job's completely done. So
Right.
that would be on the books.
Yep.
And same with paying some of the materials.
Mhm.
They'll hold 5% and won't bill us that last 5% until they know we're going to pay for the job.
Right.
So that's
Right, but those become adjusting entries from the CPA. And that's why I talked about in the normal daily transactions that we would do is bookkeeping. We're not keeping track of that. The CPA is keeping track of it at a higher level because of our taxes. If you were to be doing business for the state of Oregon or for the federal government, there's going to be different requirements for that too. And they may hold out payment over a period of time. Those are not unusual. But most food trucks don't have that experience, right? Or most cleaning services, you're not going to have that. Unless you're cleaning for every government office in the state and they're paying you on their terms, right? It'd be a terrible thing to have to deal with. We do have, Sam works with a nonprofit, and so there is some things that she's going to deal with that are going to be a little different than others because she's got grant funding. And so when you have grant funding, you are going to have it cross over. And again, but she also is going to have auditing that's going to take place that most of us don't have. When I'm done, I'm out of here. Temporary accounts. So these are the ones that begin each period with a 0 balance. So those are the revenue accounts and the expense accounts and the owner's withdrawal account. Every year, January 1, we start with 0 because we're only capturing what happened between January and December, unless your fiscal year, right? Or on a different cycle, whatever that cycle is, typically it's January through December. Any questions on those? Am I going too fast?
I have a question that might be off subject, but popped in my head, so I thought I should ask. When I'm paying taxes, do I pay taxes on my net profit and then also pay taxes on my owner draws?
That is a question for your tax person. Because I'm being recorded and I am not answering that question.
But your owner draws shouldn't affect your net.
No, okay. Yeah.
So on your profit and loss or your income statement, you're showing income and expenses. And then your net income is the difference between those two. So you either went in the hole or you didn't, right? And then the question Christina is asking actually affects the balance sheet, right? Because I put money in or I had a profit that has moved over from year to year. So I'm kind of pulling out of this other basket that's sitting here. And so it's not coming out of my income and expense. It's coming out of my equity.
But
But now this is with owner's draws. Owner's draws. So it's not just writing yourself a check and it's not just, taking cash out of petty cash and recording it as owner draw. Anytime you use a credit card for something, your business card for doing something personal, that's an owner draw. And that's where stuff gets. Now you gotta break down that whole entire credit card bill and pull out owner's draw off that whole entire credit card bill.
Here's a fun one that a lot of people will argue with me and other bookkeepers about. I stop at Lindsay's every day on the way to work and I get a cup of coffee and I put that on my business credit card. I'm not looking at you. Vicky's never done that. If you hadn't started laughing, we were okay. It's actually mainly contractors who do this, right? I jumped in my truck and off I went. You can stop and get a cup of coffee every day at Lindsay's for $5 if you want to. It's a personal expense. However, I know you are working.
It's advertisement, so therefore it is a business expense.
So I said, however. So, yeah, how many times? Now, if they have that fishbowl that says drop your card in here and we're gonna pull a winner, yeah, every day I drop a business card in there so I can win my coffee. But let's say that you're meeting a client and you say, hey, can I pick up a cup of coffee for you? And you're meeting with a client and you pop into Lindsay's and you pick up 2 cups of coffee. All you have to do is write on the receipt that you met with XYZ business. Total, both of them completely deductible. Another one, I'm here, and again, please check with your tax accountant. Verify what I'm saying to you. If I'm a contractor and I had a job up north, I have a cup of coffee at home, right? And I eat breakfast, but now I'm up in Manzanita. Can I buy lunch and it be on the company? So there's a radius of where you're not, like I can't go home and have lunch, right? And so then that becomes a deduction. Again, check with your accountant, because if you're buying soda pop and candy bars, they may, yeah, that's a snack that becomes personal. But if you have lunch, you go out to the valley to buy supplies, that's all business, right? It's all business. She's going to Mexico and she's buying stuff she can only get in Mexico. Right. And she's taking her friends to help to make connections for their businesses. Yeah, I don't see. So you can talk with Vicki and her tax accountant later. So this was a conversation earlier, right? Debits and credits. It's a helpful sheet. And I'm not gonna lie to you guys. I will tell you up front, I think I have it figured out. And then I go in to make a journal entry and I doubled something and I'm like, ugh. So I just go back in and I fix my journal entry and I go, there I go again. So it's based on what's happening to the asset or to the liability as to whether it's an increase or decrease. And it's just, it messes with your mind. Like, just don't think about it too hard, do it and fix it. It's just not worth the stress. I just, cause yeah. This is why people cry during accounting classes and quit. This is it right there. Yeah. Yeah. This is the advantage to like QuickBooks and software is it does. So I go in and I record my revenue. QuickBooks does the other side. I don't need to know whether it's an income or expense, right? I just go to QuickBooks and I do my invoice and it puts it where it's supposed to. You need to know these, excuse me, especially when you're having to do journal entries. Or so if I buy a large piece of equipment, there's two things that happen. If I put it on the books as an asset, let's say I bought a truck, I have to put it on the books as an asset, right? But I owe money on it. So then I have to book the liability too. So I write a check out of my checking account for the deposit on the truck. So that's got to come out of my checking account, right? It's actually going to come out of my income and expenses. And then my accountant is going to tell me how to do the journal entry to put it on my books. You guys don't have to know that. Yep, yep. And that's why you pay them. Recording a journal entry, we're not going to spend a lot of time on these, but it's showing you again, right? Cash on 3/1. He put 35,000 in. It's a debit because it made the account go up to 35,000. It's a credit. Credits are always on the bottom. So you always see debits and credits. It'll always be that way. So when you look at it, that means if it's on the top, it's going up. If it's on the bottom, it's going down. Evaluating transactions. Woohoo! So we talked about this, right? Determine which accounts are impacted. We talked about whether the balance in each account increases or decreases, and then by how much. So step 3 is, let's say that I go to Fred Meyer and I spend $100, but I didn't spend it all on one thing. I bought some office supplies. I bought what can you buy at Fred Meyer? Yeah, food. Huh? Cleaning supplies. Yes, good. There you go. Perfect. Thank you. So I'm going to have some of it split between office supplies. I'm going to have some between cleaning supplies. And let's just say that I have an account that's set up for a break room. Maybe I buy coffee, napkins, that type of stuff for the break room, right? So now I've got to split it 3 ways. And so that's why it's saying by how much each account is debited or credit. Because I'm still going to take $100 out of my checking account. It's going to be how much affects each one of those. So they call that a split. So I'm not going to spend a lot of time. You guys have this in your notes. This was from our last week, talking about the donuts. You have money that come in, right? Money that goes out, cash, service revenue. So it's always funny because you got cash, right? And then your revenue is a credit. And you're like, why? That doesn't make sense, right? But your cash went up and your revenue, you have to have a debit and a credit. Yep. Then when you go to the bank credits it. Yes, don't even go there. Okay. T accounts. This one I love, and most of my clients hate when I pull out a sheet and I do a T account. The reason that I will do a T account is because you guys know where the one side goes. I need you to tell me what's happening on the other side. So I know that an asset is going to be a debit and a credit. A liability is going to be a debit and a credit, but they flipped, right? So each one of those is going to have a side. These are going to be important when you do them, and we'll do some T accounts as we go along. But it always comes back to, it's either on the cash side and it's making my cash go up or down. So then what happens on the other side of the T? Right? So I gotta, yep. And those happen, that's why I said the wonderful part of T accounts is that's happening in the software on its own. You don't have to memorize this. And then when we look at this, so it's talking about how to calculate the T account, is we're looking at the cash that came in and the cash that went out and the difference, right? And that's how you would look at it. So we know that he brought in 35,000 when he started the business. He had 850 in sales. that first day, and then he had another 300 in sales, right? So he had his debits equal 36,150, and then he spent 23,850. And so in his account is left 12,300. So I'm not going to spend a lot of time with these unless you guys have questions, but special journals are going to be things that take place automatically in QuickBooks. So what we're talking about right now on 1 through 4, and we're going to go into 5 tonight, is we're talking about accounting essentials and all the things that are happening in the background that are things that you need to understand and have knowledge of, but nobody's expecting you to know this and like be able to recite this. It's that then Megan and I work together quite a bit, and there's times when she'll say, how did you know that? Like, how did you know that that was off? And I'll say, because it was revenue and it was in an expense account, it had a negative. Revenue can't have a negative, or expenses can't have a negative, I should say that. So what would happen is like, it automatically catches your eye because you're like, wait, that's not right. And then you go look at it, and what happened is instead of being recorded as a revenue, it was recorded as an expense, and you just fix it. Okay, I know Christina's going, yeah, just fix it. So, but it takes years to do that. I know some accountants that could look at it and it would be out of balance by 28 cents and tell you why. They had like this formula, and I'm like, it is. Peggy will tell you I'm not allowed to choose games. So when it talks about special journals, the cash receipts journal, cash payments journal, revenue journal, purchases journal, you're never going to see those. So let's look at this sheet. And I don't know, Megan. Yeah, I'm not sure how to show them. Maybe if they have QuickBooks, they could pop it up. I don't think so. And I don't know which cameras, like, which one is the camera? None of them. Oh, perfect. Go, Megan. So these are called modules, right? So at the top, and I don't know because it probably didn't copy real well, it says vendors. And so everything there has to do with entering bills and paying bills. And can you see the arrows? Did they copy? Okay. Yeah, barely. So the point behind this is that follow the arrow because it tells you what to do next. But each one of these has a journal that you're not seeing unless you actually need to go to the journal, right? If I click write a check, it takes me right to the check register and I write a check. It's putting it on the purchases journal and I never see it. You see it in your check register, but if there's a problem, you go and there's certain ways that you can go in and you can find it. It's just that most people don't realize that they're doing two journals at the same time because QuickBooks is doing it for them. It used to be that when we did it and we did it on paper, we physically had an accounts receivable journal and we had a checking account journal. And so we would write on this one and then we would go over and we would write on this one. So it's a double entry system, meaning we write it one time when we write the check and it puts it to the other journal. So we'll get to a point when we go into QuickBooks and I will show you where these things are. But just so you know, as we're talking about these special journals and you're like, never seen them, you won't until I show you them, okay? Same thing with the ledgers. You're not gonna see accounts receivable or accounts payable unless you run those reports. Those are specific reports that will tie in, that will tell you, I've invoiced 10 clients. Here's the amount they owe me. I have entered my bills that I need to pay. Usually it's going to be credit card or something I have on account. And this is when I need to pay it. There are reports for both of those. So that ledger is being done again in the background. You guys don't have to worry about it. You just need to know what's happening. Trial balances. So the time you're going to hear about a trial balance is when your tax person says, I need your bookkeeper to give me your trial balance for the year, and I want it in an Excel spreadsheet, and tell them not to touch it again until I'm done with taxes. So the trial balance shows everything you've done in the accounting system from January through. It shows both sides of every transaction. And the wonderful thing is it's supposed to balance. So when you get to the bottom of the trial balance, your left better equal your right. If it's out of balance, they've got to find it. Well, they're going to have you find it, but you know, that's going to be, yeah. Or they're going to help you find it. They're going to tell you, you did something wrong because you can't be out of balance. That means you deleted something. That means something happened. And what a trial balance will do is it'll start with the beginning balance for the year, all of the income, all of the expenses, and then the ending balance for the year. So you can see everything. Again, used by your tax professionals, not necessarily used by us in everyday business. This is the example. We looked at it a little bit earlier. It shows everything. Adjusting in entries, this is where we're talking about. They're going to give me journal entries that they're going to want me to do. They're going to tell me how, why, where, and I'm going to put them in. And so that's going to be depreciation. Cynthia was talking about deferred expenses and deferred revenue because they have that 5%. So that's going to be booked, but most of us don't have that. The impact. So here we go again, right? Up and down and around. It affects your taxes. This is what this is for. It's an impact on the accounts, but ultimately it's an impact on how much money you either are claiming as income or an expense on your taxes. Reversing entries. These are optional journal entries, and usually those are, oops, I made a mistake, fix my mistake by reversing it. It's a mulligan, right? I just say, fix it. And those, again, are going to be done because somebody's going to tell you to do those. Depreciation. So what happens with depreciation is if you own equipment, brick and mortar buildings, those type of things, they have a lifespan that is determined by the tax laws. So let's say most buildings could be a 30-year depreciation. It means when you buy that building, you can't take, let's say I paid $100,000 for it. I can't take that whole $100,000 as an expense. I have to take it over the 30 years, right? That's what that depreciation and those things come into play. Same thing will happen on equipment. Most of the time equipment is based on the hours the machine is used, not on the machine itself or on the year. I don't know how that works on like even cleaning equipment and stuff. It may be the life or year, like, you know, we expect this cleaner to last 5 years so you can depreciate it for 5 years. Because I don't know how you would determine hours. On most equipment, it actually shows the hours used.
Yeah, but some of our stuff, like with the vibrators, the rock vibrators, they'll actually go off the warranty. They'll ask us, well, how long is the warranty?
Right.
So if it's a 5-year warranty, they'll depreciate it over 5 years.
Right.
Because once that warranty's over.
Right. And sometimes, so you look at the difference in computers, you know, you could, it used to be $2,000 or $3,000 or $4,000 even for laptops or computers. And now you can go to Costco and buy one for 300 or 400. They're gonna depreciate the Costco one out. If they even, I mean, they're just gonna do it as an expense. They're not even gonna bother depreciating it, right? And then once you get to a certain point, they're gonna say, okay, we're gonna depreciate it. And they have a choice whether they take a full depreciation or they do it for the warranty. We've gotten to be such a disposable world where it costs less to buy a new one than it does to fix one, or there's not parts available, and so that will dictate. And they have formulas and they have things that they follow with IRS code that tells them what all that is. You just need to know if you buy a really big, anything over, I would say, 1,500 up, your tax accountant, make sure that you have that recorded, what it is, when you bought it, etc., and they're gonna depreciate it out for you. We're not gonna talk about straight line, it's all the same. It's depreciation. So they're kind of just showing year 1, year 2 through 5, right? They're showing the value of it. So what it's saying is by year 5, it's only worth $250, right? So you've depreciated it. And this is where we talked about, if I buy a piece of equipment, like I just really got lucky, and it was a saw for 500 and the person had no idea the value and they sold it to me for 5 because they just wanted to get it off their property. I can depreciate it. They'll do a straight line depreciation because that has value, but I can still only claim I paid $5. Okay. And then they show us how to do the journal entry, which by the time you guys have to do these things, I'm hoping that you're a year or 2 in and your bookkeeper or your tax, you're in QuickBooks Online, your tax accountant says, give me your copy of QuickBooks, and they do it and then tell you now you can get back in your, right? Because it's just much easier for them to just do it. All right. So let's take a quick break because it's been an hour. And before we start into financial statements and closing entries. And if you guys have any questions or anything, we can work through that. We're going to spend a lot more time on this, and then we're going to go into the penny game.
Okay.
Yes.
Okay.
Problem.
Good exercise.
Actually, can we, let's run, because you're not able to flip them. We need them side by side.
Oh, okay.
And then,
One page.
how many?
How many do we need?
Oh, thank you. I'm looking for this. Okay. Thank you, I appreciate you.
I appreciate you. Pennies.
I don't know.
I'm scared. I'm scared.
Were you scared to go outside in the dark?
No.
this one.
What we said. I gotta go find my beans. Gonna do bean counters tonight.
Oh, yeah. I just wanted to make sure you were out away from Gale's break. Okay, well, just remember the dogs tomorrow. Okay. All right, text me when you get home. All right, bye. Oh, boy.
Yeah, sure, we don't.
Yeah.
Yeah, this is what this is the last year. Other people. Yeah. That's all. Yeah.
No, or radish seeds are nice too.
Is the corn at least corn? Like.
Oh, I think so.
One. Well, that's fine, we can have one.
That's Betty.
Yeah, that's fine, just give them one. They should
Well, they need
all-
one from that.
Yeah, but they have one.
Oh, they have one. Oh,
Did you do 20?
no, I think.
No, yeah, just give them one, they're gonna use one and then the other.
Here's the original.
How many is that? I'm gonna give you about 20.
Oh, when this, foods.
I just start to like. Say, so for instance, like, for us, we over here on this. That was.
It's considered a startup. And so the same thing would happen, you would talk to your accountants about it, you would tell them this is what it costs to move over, to relocate, they said, right, not just the building for the business. And you've got 17 months of expenses, and sometimes they'll split that over a period. You can't take it all at the same time.
Oh, that'd be nice.
Absolutely nice. So I have a question on that, QuickBooks Online stuff. Is that a little out of the bird?
Do you need more?
I have 16.
Oh, she did everything.
I didn't have pennies and somebody stole my beans. I was gonna let you guys all be, yeah, it was probably you. Now that I think about it, it was probably
How often do you see each other?
You know how like just blast it to the last. I did appreciate you. That's the part I
What did I do?
So I was getting my bed, I was like, I mean, it's busted for this. I don't think we're, like, I'm getting hot from the weeds.
Yeah, no, yeah. Perfect. Well, and you- Yeah, I know, I know.
I love
That's a whole nother monster.
So Riddell and Jenny, you guys are gonna want to get if you're there, you're gonna want to get something to play the penny game with. We're not gonna jump on it right this second, but when we do, pennies or beans, or we're using paper clips because Peggy stole. I mean,
Is there a certain
Peggy-
amount we should have?
Peggy didn't steal them. She hired someone to move them.
Is there a certain amount of number or a number of pennies we should have?
Did they not get a PDF?
No, that's this.
It's the last, oh, yeah, they didn't get it back, but they should have, I didn't really ask for a response, but, the last 2 pages of the slide deck is the penny game.
Okay.
And they could just watch and laugh with the rest of us. All right, so please, don't throw away the paper clips, give them back to Leon. We're on a shoestring budget. If we had, we lost our beans. We were actually out there looking at the seeds and going, if we gave you carrot seeds, like they're tiny, but we think the corn seeds might work. We're like, no, we're so, hey, we gotta laugh, right? Or cry. So, couple things that came up during break. One was, Charmony asked, they relocated to start the business. Does that happen to be in an expense that can be deducted? Yes, it can. Now, again, please work with your tax consultant because there are rules on how that plays out. But for the first 17 months of starting a business, you can capture what they call startup costs. And those startup costs, depending on how much it is, if it's more than what the IRS allows, they'll split it over a 5-year period or 2 or 3 year period. So even though you may not be able to take, let's say it was 100,000, you might not be able to take the 100,000, but you might be able to take 30, 30, 30. So yes, keep track of that. And it's one of those cart and horse, right? I can't start a business without spending some money, right? It just doesn't happen. And so how does that work? The other question escaped my mind. So if it comes back, you can let me know. QuickBooks Online, something about QuickBooks Online. So Accounting Essentials has 9 modules. As of today, we are on module 5, which means we're going to have 2 more, probably 3, depending on how much information is in them. I'm going to try to combine them. And then the rest of the time, it's going to be QuickBooks Online, deep dive into QuickBooks Online, doing the actual program. Okay, so I know this part is like, when we get into QuickBooks Online, that'll help, but this will be important to what you're doing. Financial statements and closing entries. So on the income statement, it says it subtracts expenses from revenue to display either a net income or a net loss. And so what's gonna happen is at the bottom, right? We pulled in everything over to the right side. We brought in 31,000. We spent 5,300. Our net income is 25,700. This is an auto repair center. And so they're showing, basically, I would consider this to be more of a service-based business. If this were a coffee shop, they would have, and we talked about this a little bit, cost of goods sold, right? Where I've got my cup, my sleeve, my lid, my straw. So those would actually go up with total revenue, and those costs would be deducted so that I don't pay taxes on those costs. And I always think about that as what walks out the door with the customer, right? So let's say I go to a restaurant and I get a to-go meal, the to-go container and the food that went in it, right? The to-go container, if I do silverware, anything that I send out the door with that customer, a bag to put it in, that's all considered cost of goods sold. And that comes off, so let's say it was a $15 entree, and it cost me $3 for those supplies, then I'm only gonna be charged on the 12, not the whole 15. So it makes a difference, because what happens is on your total revenue minus your cost of goods, minus your expenses, means that you're being taxed on what you actually made versus taxed on, you know, when I talk about a cup of coffee, I paid $5, but there was $2 of cost of goods. The owner actually made a profit on the $3, not on the whole 5. So that becomes important on how you do that. We talked a little bit about labor with that too. So if I have a barista who is making the coffee and I have a manager, the barista wages are going to go towards the cost of goods sold, and the manager's wages are going towards running the business, right? But let's say sometimes he or she gets called over to make coffee. I need to know that, right? So let's be honest, the first year it's probably me. I'm all of the above. So those are things that if you hear the word cost of goods sold or COGS, that's what they're talking about. I think the coffee cup is the easiest, to me, it's the easiest visual to go, okay.
The lease's time
Mhm.
is also
Right.
cost the owner that employee
Mhm.
wage to that.
Right. If you were in construction, your drywaller, your plumber, you know, any of those are going to be cost of goods sold, because what they did is what created the job. The person back in the office that is billing and invoicing and doing all of that is not considered part of the labor that goes into the product. Statement of owner's equity. This one's funny. I haven't seen this one as much as they're using it, but it displays how much money came into him and how much money went out. And so, you know, he started with capital of 225,000. He had income of 25,700, investment of 5, and then he paid 5 out, right? Well, the increase came in from that 25,700 right there. Net income. That's where that 25,700 pulls over. That's the only time that you see the information from the profit and loss pull over to the balance sheet, is that number right there. And you're going to see it again. This is the balance sheet, and they're not showing it on here because they're showing it on the previous statement. Most people don't run that statement of owner's equity. It usually shows on your balance sheet. So what'll happen is on your balance sheet, it will show the owner's equity will actually be broken out to show what it's showing on the previous slide, if that makes sense. Statement of cash flows, we talked about that. If I'm using my accounting program and all of the things that are in it, I'm gonna see that cash flow happen. If not, I'm not gonna see it happen. So I don't know a lot of people that look at the statement of cash flows on a monthly basis because it's just not something that they're doing. So this is a statement of cash flow example, and it's saying that we actually, right, need to have 3,140 more dollars to cover the bills, right? Our revenue. And that's what it's saying is that there was a decrease in cash, excuse me. There was a decrease in cash during that period. So we started, our beginning cash balance was 178,140, and we spent 3,140 more than we brought in. Closing entries. So this is the one that we were talking about earlier where everything goes back to zero. And so the balance of temporary accounts go to zero. And this is where you see that 25.7 goes directly over to the owner assets. So the temporary accounts include revenue, expenses, and owner withdrawals. So we're going to see it in a few minutes when we play the game. But basically what we're saying is that this 25.7 that's showing down here at the bottom is net income. That's going to go over into the balance sheet. Everything else goes back to zero. All right. We looked at that. And the closing entries take place automatically in QuickBooks at the end of the year. It'll ask you what your calendar year is, and it's part of the process. It does it automatically. You used to have to do it, and it was quite a challenge. And as you can tell, because they have this lovely little thing, you had to do it in certain ways. And when you closed it, if you closed it, you had to password protect it. And then if you reopened it, you know, there were certain things that you had to do and you couldn't do it out of order. And so that's why they're showing first, second, third, and fourth. It takes place in those steps. And if you close it, you got to go backward in the same way. You guys are thankful that you're in QuickBooks Online, actually QuickBooks period, but. And then this is what happens when we talk about a post-closing trial balance where it has the debit and the credit and they both balance. This is a really simple one. It excludes all the temporary accounts on this one. All right, so now we're gonna play, you should have these two. You're gonna have my balance sheet, and Leon did some, because we had them front and back, you're gonna need a balance sheet and then flip over on the other side and you should have the profit and loss. Yeah, you have one in your package and then Leon did another one. And then I'm gonna have to get the slides. So give me just a second. With gears. Let's see if I remember. I think I have to stop sharing. It's like it will not let me. I hope I have the right one. We're gonna find out. This is, like I said, Peggy's favorite. Okay, are they able to see that as well? Don't let Peggy sour you on anything. Yeah, she's got a tax man. All right, So fun with financials. So here's a couple of things, is that you're gonna need your paper clips. And if we don't have enough, there's some extras back there. And we'll keep you going. Otherwise, we'll go down and steal some corn out of the hallway. I guess we could have done potato chips. So you're a business owner. Congratulations. And you manufacture your products. Congratulations. You sell widgets. Do you guys know what a widget is?
No.
Okay. This is a widget. Right? It's whatever it is. It's the product, it's stuff I need. So I have to buy all the components to build this, and then I sell this. So what's a widget? Your widget, let's say your enchiladas, your chips and dip, and yeah. The margaritas that you should bring to class, those would be your widgets. So it's the thrill of your lifetime to observe your financial statements, and please no throwing tomatoes at the instructor. All right. So what are the parts to your balance sheet? So when you look at your balance sheet, you should have 3 parts, right? So you've got cash, you've got equipment. Here we have grandma, remember Miss Nora, your widget inventory, your accounts receivable, your line of credit, your owner's equity, and accounts payable and net income, okay? So when you look at them on the balance sheet, this goes back to that equation. This goes back to your equations. Assets equals current liabilities plus equity, right? Now, you have a left side and you have a right side. This is the T account. Whatever I have on the left better have something corresponding on the right, or I'm out of balance and there's a problem. All right, profit and loss. What's on it and why? So your net income, here we are going to talk about cost of goods sold. And then we're going to talk about the operating expenses. So I have rent, I have marketing, right? Advertising, I've got widgets, I have my revenue, and I have my expenses. Those all have a place on my profit and loss. So when we look at that, our revenue is always at the top, and that's everything that's coming in. Our cost of goods sold are going to go between income and expenses, and then we have a net. Everybody got your paper clips and you're ready to play. You get the business started by investing 2 pennies of your own money. Where does this go? Goes on your balance sheet, and it's putting your cash up, right? Nothing happens on our profit and loss. I open my checking account, I put 2 pennies in there, and I have 2 pennies in my owner's equity. So you have 2 paper clips on your, so Vicki, you're right, but you got 2 over there, now you need to have 2 over there under owner's equity. And I'm going to tell you this, don't stress by what's in front of you, just and cheat and make it match. You should have seen me the first time I did it. I was like, I'm supposed to know this. And I was getting lost. And so I was like, I'm just going to make a match and then we'll talk. All right. You pay cash for 2 pennies of inventory. Does it show up on your profit and loss? It's an inventory. It's an asset. So it's only going to show up on my balance sheet because it's an asset. I haven't sold it yet, right? So I took my 2 pennies out of my cash and I bought widget inventory. Oh, yeah, sorry.
No, that's okay. I thought I heard you say something.
Sorry.
On Zoom.
Oh,
Like it's, like it's,
oh,
so maybe next time we'll.
yeah. I have no idea how to do that. Just the game?
Well, when you
Everything.
update it to the screen, I got the responses back.
Everything is backwards.
Can you reverse it?
I don't know. That would be IT. I bet you if I was zooming off of this one, because this one is controlling and that one is,
I think in video settings.
well, at this time at 8 o'clock, yeah. I'll talk to Nicole and, I mean, it's not, but that would be like us to figure it out at 8 o'clock. All right. You borrow 2 pennies from grandma. Does that go on your profit and loss? No, because we still haven't done any business, right? We're just still over here trying to figure out what we want to do. So nothing's happening on our profit and loss. But now we borrowed 2 pennies from grandma, so we put 2 pennies in our bank account and we owe grandma. So now I should have 4 on the left and I should have 4 on the right. I don't know. Okay. All right, so you got 4 and 4. Now, you paid 2 pennies cash for equipment. Profit and loss? Nope, we're still not doing anything, right? We're still setting up our business. So we take 2 pennies out of cash and we buy our equipment. So all we're doing, if there are times in your business where you feel like all you're doing is moving money around, this is it. You're like, I'm not making any money, right? I'm just moving money around between accounts. This is why. Perfectly normal. Now, you sell 1 penny of inventory for 1 penny of cash sale. Okay, so now what has happened? Now on your profit and loss, you actually sold something. This is Nathan's donut. He sold a donut, 1 penny. And then whatever it costs to make that, right? The inventory of the widget comes out of there. So it's going to affect, this one is going to affect both my profit and loss and my balance sheet. So now my widget inventory goes down to 1 because I had 2, but I sold 1. And then my cash goes up to 1. So I still only have 4 pennies, but they've moved around a little bit on the sheet. The other thing to keep in mind, this is like weighing. Don't do this every day because you'll drive yourself crazy. You pay cash for 1 penny of inventory. Anything change on your profit and loss? No. Because you took that money and you went and bought your inventory. You brought your inventory back up. So now you've got 2 to sell instead of just 1. Okay. Now you sell 1 penny of inventory for 2 pennies of cash. That's better. So now you add those 2 pennies up there as income. You have 1 penny on your widget, right? Which was your inventory. And then, so when you look at it, you've got 3 pennies, expenses are 2. That means you have a profit of 1. Congrats. Now, what's happened to our balance sheet as a result of that? See, now it's fun. Now it's fun. I think this is at least your 3rd, yeah. So, So you got 2 cash, your widget inventory went down to 1 because you sold 1. Your equipment hasn't changed. You still owe grandma 2. The owner's equity is 2, but now you got this penny down there in net income. So my penny came over from my profit and loss over to my net income. All right, now you buy 2 pennies of inventory on credit. On credit. So it's not gonna affect my profit and loss, right? Because I didn't buy or sell anything. I actually bought it from Rosenberg's, right? And put it in my inventory. So now I've moved up to a whopping 7 pennies. And I'm still just going back and forth trying to get my business set up. You sell 1 penny of inventory for 2 pennies. Are you guys running out of paper clips? You're out? Are we, sorry.
Yeah, we're having so much fun. We need to get some more paper.
Either that or grab the corn, or let's see, is there corn chips? Is there? All right, so I'll let you catch up when he gets back.
There's more
So
paper
now-
clips at my desk.
Oh, it's in your desk?
Yeah, the drawer by my desk. There's a bunch of paper clips.
Okay. So now we've made $5 or 5, let's just call them dollars, pennies. $5, our widget sold for 3, now our income is 2, right? That makes sense. You guys can just put it on your profit and loss and I think he's drawing paper clips. You could put X's. Your balance sheet goes up because now you have 2 more pennies of cash and your inventory went down by 1 and your net income went up by 1.
We had 800 pennies.
I know, we did, didn't we? But I don't think we used them all. Did we run out of pennies last time? See, that's why I thought we did the beans. Okay. All right. So now you pay grandma back 1 penny. From the cash, right? Goes from the cash and it decreases your loan to grandma. So now you take it out of cash. You should have 3 in cash. So you should have 3 in cash, you should have 2 widgets of inventory, and you should have 2 pieces of equipment. And then you have 2 accounts payable because we got to pay for the inventory. 1 loan to grandma, and then we have 2 on owner's equity and 2 on, yeah, you guys are doing great. Now you pay 1 penny for rent. Yeah, now you're really in business, right? Now starts the bills. So now you got to pay rent, right? And where did rent come from? It actually came out of your cash, right? And so you're going to pull it out of your net income. And you're going to pull it out of your cash. And your net income. And the one on your balance sheet comes out. Nope, take the rent completely. You just have 1 under rent. And then over there, the net income, you should take 1 paper clip off right there. Yep. All right. You sell 1 penny of inventory, sorry, for 2 pennies and you give credit. So you sold 2 or 1 penny of inventory and you're gonna let me pay for it in 30 days, right? So you have 2 pennies that show up on your profit and loss. You have your widget, and then your income went up. You should have 7. Some things submit. Oh, a sucker's a bad. And then your balance sheet, now you've given credit, right? But it doesn't go in your checking account because they haven't paid you yet, right? So it goes under accounts receivable. And your widgets, now you're back down to inventory, you've only got 1. Do X's if you need to. Yeah, just do X's. And then we've not changed anything over here other than our net income went up by 1. But we still owe 2, we still owe grandma. You borrow 1 penny using the line of credit. It doesn't. This affects your profit sheet. You now have a line of credit, right? And you put that in your checking account. So you're doing everything you can. Are you out of paper clips? Yeah. Well, and that's the thing, right? You're doing everything you can to stay afloat. And you're like, oh my gosh.
Now I owe Peggy.
You pay down 2 pennies on your accounts payable. You take it from the cash. And you take it away from accounts payable. Because now you don't owe it anymore. Doesn't affect your profit and loss at all. Just the balance sheet. You have 1 penny, you owe. So yeah, so if we were talking. Well, because so really, they're gonna look at this, right? And they're gonna say, wow, you have a penny in the bank, somebody owes you 2 pennies, you have an inventory of 1, and you have this piece of equipment. But you owe a line of credit and a loan for grandma, so we're gonna take that. And this is again where Miss Nora was really upset that grandma wasn't paid. You know, what's happening here? And this is where oftentimes, and so year 1, year 2 of small business, it's not unusual to see this, right? Yeah, it feels like it. It feels horrible. You're just like, oh my gosh, why did I do this? And then you'll start to see things change. We'll talk about a couple of things towards the end as well, but now you pay a penny for a marketing campaign, which why would you do that? Right? But you have to get more business, right? So these are the decisions that you have to make. Well, you're going to take it from on your profit and loss, you're taking it from the penny down on the net income and you're putting it up under marketing. Well, you have 1. Okay. On your profit and loss, you took your 1 penny cash, which means you only have 1 penny on net income. Nope. And then you have to, take 1 off of your, what? You good? Okay. You're welcome. So now you buy 1 penny of inventory on credit. So now you're buying inventory, so you have something to sell, but it's on credit, right? Doesn't affect our profit and loss, but it affects our balance sheet because now we have an accounts payable, but we have 2 widgets. So this is feeling like Monopoly, right? So you sell 1 penny of inventory for 2 pennies and you give credit. So you got 2 pennies coming in, right? In your revenue. and a widget. And so you have 2 down at the bottom. Leon, we're gonna have to find, like, go to some, I wonder if Amazon's got like some type of penny or something like for school money or for games for teaching or something.
Why not always penny a watch? But they were still made everyone's fingers feel.
Yeah, they were, everybody was like, "Eeh." No, he couldn't. Everybody was like, no, we're good. So we still have no cash, right? But we have 4 pennies out that people have promised us they're gonna pay us. We're down to 1 widget. We still have that piece of equipment, thank goodness. We owe accounts payable, we owe a line of credit, and we owe grandma. Okay. A customer who owes you money sends you 1 penny. So that goes into cash, right? Goes from accounts receivable up to cash. It's now in the bank. No, nothing changes on the P&L. You already accounted for it. Now you take an owner's draw because you're making so much money of 1 penny, and this decreases your equity, right? So it's not going to do anything to our profit and loss. But we took money out of the bank account, right? And it's got to come out of our owner equity, or this is where we talk about owner draw, member draw, those type of things. That's where that's coming from. So we're now back down to no cash.
I have a question. With an LLC, why can't an owner be on their own payroll?
Oh, that's question.
You have to be a sub S corp or a corp, because you own the business. All of it belongs to you,
Oh, okay.
right? So you can't be an employee and an owner of an LLC. There comes a point. Yeah, she's mad about that. We've had this conversation a couple of times. So there comes a point. Well, and Vicky was a sole proprietor. Can I share? Sorry. Sole proprietor, moved to an LLC, and her next step would be to move to an S corp, and then she could pay herself. But it's that kind of, when you start, right? It's all you. The business has no credit, it has nothing, so it's relying on you. So it's kind of that, now it's its own entity, it's standing up, it's walking on its own 2 feet. Then you start, you're still an LLC, but you are taxed as an S corp. You pay yourself, it becomes, but you don't get there like from day one. It takes time to get there. You buy 1 penny of inventory on credit. Didn't change anything on our profit and loss because we didn't do anything in the business per se. We did, but not on the profit and loss. So now we owe 2 in accounts payable, but we also have 2 pieces of inventory that are available for sale. A customer defaults on 2 pennies on accounts receivable. He doesn't pay his bill. So now you have this expense that you have to write in on your profit and loss that says bad debt. You're gonna have to write it in. Doesn't exist, right? It's gonna go from your net income up to bad debt. Now, I will tell you this, for those of you that do service, if you accept a partial payment and the person doesn't pay the rest of it, you okayed full receipt of that money when you accepted the partial payment. So what I encourage my clients to do is, like, let's say I owe $200. You came and you cleaned my carpet and you say 200 and I give you 100. You say no. I didn't set up a payment plan. Here's your 100 back, you owe me 200. Because once you accept that, you're saying you accepted $100 for service. And so then what you do is you say, I'm happy to take credit card or, you know, whatever, or you say, I will set up a payment plan for you, and you write out a payment plan and you have them say that, or you have them sign it, right? And acknowledge that they paid you 100, you're in receipt of 100, they still owe you 100.
So like, for instance, this will be written.
Mhm.
That works best for us.
Mhm.
We have an like a invoice that we gave the customer, they gave us 100. We can write out another invoice showing that we received 100, and then 100 is still owed.
Mhm. Mhm. Because if you do not, you have no recourse. It's the latest and greatest trend of, you know, once they found out that, hey, well, you accepted 100, that means that was, you know, it's like, I was doing it in good faith. All right. No. Yeah. Oh, yeah. Right. Right. So our accounts receivable went away, right? We can't count on it. Our net income went away. And so now we have 1 penny that's coming in. We have 2 widgets in inventory. We have a piece of equipment worth 2 pennies. We owe accounts payable. We owe line of credit, the loan from grandma, and owner's equity. You're a banker. You want to loan me money? Mm-hmm. Peggy said it's a sucker's bet. All right. So now you sell 1 penny of inventory for 2 pennies and you give credit again. You guys are trusting. So it's going to affect both our profit and loss, right? Because we got 2 pennies, 1 widget, we have net income of 1. So our accounts receivable went up to 3, our widget went down to 1, and our net income went up by 1. Now the customer who owes you money sends you 2 pennies. Yay! So we've already recognized the income on our profit and loss. So we're going to jump right to our balance sheet. We're going to take the 2 pennies off of accounts receivable. We're going to move them up to cash. That's the only thing that moved, correct? Our right side is currently, we're all in balance. Now you pay down 1 penny on your line of credit. Yep. This is when grandma's like, I should come before the line of credit. That's the only thing that changed, cash and our line of credit. Now you buy 1 penny of inventory on credit. Again, nothing happened on our profit and loss. Only happens on our balance sheet because we actually bought a widget and we are paying for it later. Because it's starting to kind of, you got the groove. I mean, I know you're still questioning, but now you pay grandma back and she buys you cake. Had you have known that, you would have paid her back first, right? So nothing happened on our profit and loss, but we used our cash and we paid grandma back. And you got a cake. Yep, we don't owe grandma. You don't owe grandma, but yeah. So what's your gross revenue? What's your gross profit? What's your gross profit margin? What's your net income? I know. And what's your net profit margin, right? What's the walkaway value of the business? Which is larger, your debt or your equity? Mm-hmm. Okay. So at any given time, this is why most small business owners quit every other day. And we're like, and if we started, classes with this particular scenario, most people would go, "Ah." Yeah, but this is real life. So on our profit and loss, this is only what happened for the month of January, right? So my balance sheet that we're using right now is only showing January, right? But let's say the true picture is that I have all of the previous year. So maybe I have $10,000 in cash. So that's the thing, is this is a snapshot in time. It's whatever period, accounting period I'm in. January, February, March, whatever it is. This is my business from the day I started till today. So it looks really bleak if this is truly, like the first 10 days of my business. It looks really bleak. And you're right. A banker's not going to loan on that. And that's where most of the small businesses, when we start out, it's our cash, it's our blood, sweat, and tears, because we're the ones that are putting it in there. So if we were to look at this, let's say, been in business for 10 years, I may have 250,000 in cash. I may have $500,000 in owner's equity, right? I look completely different to the bank. The accounts payable, the line of credit, some of those things are not worrisome because I've got that 10 years worth of net income that pulled forward every year from the business. And so even if one year was a loss, I'm still gaining. So that's why you have to understand the whole picture. You can't take a look at one thing because it will depress you, because it looks so bleak. Now, with this, you also have to understand, what is your business plan? Do you have a business plan? And maybe the business plan is that we're gonna take this risk and buy more equipment and double our business, but it's gonna be pretty tight for a few months. And so you're gonna look at it, you're gonna lay things out, and you're gonna make decisions based on those. That's like we talked about. Why in the world would I market? Why would I do an advertising campaign when I don't even have any cash in the bank? Right? Now, what's the other thing that I can do here? What's the other thing I can do? Okay, well, so there's a couple of things. What do I have control over is the price of my product and my expenses, correct? And when I say the price of my product, I have a choice on who I buy stuff from, right? And so if I'm buying it from a vendor and they're selling me, Vicki, what does a case of tomatoes cost?
I think $55 per now.
Okay, so if a case of tomatoes is $55, let's say from Cisco, but I go down here to the farm. Yes, Jesus, Farm Fresh, couldn't think of his name. And he sells it to me for $40. I've saved $15. That I have control over. Now there's two things in play there. Is it a tomato that needs to be pretty? Is it, or is it a tomato that's being cooked down, right? So I have to look at it. Am I gonna buy that tomato that is the most beautiful tomato to cook down, knowing that nobody's ever gonna see that it's a beautiful tomato? Now, I'm obviously not buying rotten tomatoes and putting them in there, right? But you understand what I'm saying is I have to look at it and say, how is this being used? What about, I'm paying a penny for my widget and I'm selling it for $2. Why am I selling it for $2? Maybe I should be selling it for $5, right? So I can control that. That is one of the things that I have control over. So how do I know whether it's worth $5? If I have my customer saying to me, oh my gosh, you're the best deal on the street. The guy down the street was charging $5, and you're like, okay. but you have a better product and da-da-da, and you're like, shoot, I better be raising my prices, right? Uh-huh, we did. And it's a scary thing because especially when you first start your business, you're thankful that somebody's gonna pay you anything. And around Tillamook, I hear this so often, and I went through it myself. But they'll go to Portland. Well, if they go out to Portland, they're paying $300 an hour, right? So if I'm charging $100 an hour, why should I apologize for 100? I just saved you 200. But they're gonna say, well, you know, we're kind of local or rural out here. You shouldn't be charging that much. Well, then fine, drive over the hill. When I first started my business, I had a guy who wanted to mow my lawn for me in exchange for bookkeeping. And I said, I don't need my lawn mowed. And not in a bad way. Bartering can be a great thing, but usually it's of equal value, right? And it's like, I still have to put food on the table and pay my bills. So I'm sorry, exchanging for mowing a lawn. Now, if you'd exchange for food, that might have been a totally different subject. But so you got to think about these. What do I have control over? What can I handle? What can I not handle? How can I make adjustments?
Why was there no cost of goods?
It's up here. It's the widgets.
Or just like.
It was a penny. See, we sold it for $2, but the cost of good was $1, so we only made $1 on it. Every time we sold for $2, and the first one we sold, it was 1 for 1. Right? So in a scenario where you're buying a product versus a service, that product has value. And that's what we talked about. It has value based on what's in it, right? And that most people already know what the price is because it's already on the menu or whatever, right? It's not a surprise. Services are usually by the hour. And so you're buying for a quantity of time. So you look at this, and one of the questions was, what is this business worth? What are my options at this point to be able to pay? I decide, okay, I can't do this. I'm done.
So last year's inventory and your equipment.
I have to liquidate. So I'm going to sell my widget inventory. Do you think they're going to pay me 2 for 1? We're down to the garage sale. Yeah, you're hoping you get 1 for 1. What about my equipment? Right. Because they're going to go, well, it's a used piece of equipment, right? Why would I do that? Right, right. Well, apparently the newest thing is to buy something for $5 at the Goodwill or something and sell it for 100,000. I just saw that on Facebook. Yeah, they bought a chair or a vase at Goodwill and sold it for 100,000. The person, yeah, it was a vase. They didn't know what it was. They didn't know what it was worth. You know, and we hear about it, those antique things, right? I had this up in the closet or the attic. I didn't know what it was, and come to find out it was this, you know, multi-million-dollar. Yeah, it was a Van Gogh. But most of us, even if like let's be honest, another business similar to us is going out of business, we're going to go for, are we going to pay full price for the equipment? No. Why would we, right? My accounts payable, if the business doesn't pay it, who pays it? Or bankruptcy. Yeah.
You got 2 in your equity. So your accounts payable a little.
Right. And you still owe 1. And you got grandma's cake. You better have saved some cake to share with the guy on the accounts payable. And maybe he'll be happy with accepting that part of it.
Well, whoever you owe the money to, they just have to talk to it.
Yeah, or they can write it off to bad debt. But until they do, you're liable for it. They could take you to small claims court. Yeah, you're going to have to liquidate, right? The guy from accounts receivable pays you and you pay off the accounts payable. the widget inventory and the equipment gets sold and has enough to cover the accounts payable and you get whatever's left.
Can you write in your contract?
You can. But that's kind of, it's like the bankruptcy laws, right? In other words, there's gonna be a certain part where they're not gonna take. So this matters whether you're a sole proprietor, LLC. It's gonna be, if you're a sole proprietor, they can take your house. If you're an LLC, it's limited to the business. They can't come over to you personally. And so these are why we have some of the conversations that we have with small businesses when they get started is, I always ask the question, this is where you are at the end of the day. Let's say you've worked this business for 10 years. What do you want to do with it? You want to, not if it looks like this, but let's just say, you know, do I want to sell my business? If so, I can't be a sole proprietor because I can't sell my social security number. I have to set up as an LLC. If I own this business as a sole proprietor, I'm just liquidating everything and thankful for whatever I get out, right? And I go get a job doing something else and thank God I survived the experience. And then if I'm an LLC and I sell it, hopefully I sell it for what it's worth. Now I'm always going to think it's worth more than the person is, which is why we have the appraisers and we have the people that come up with the fair market value of things, because you're going to want it for less and I'm going to want, you know, I can put $1 million on a building and say this building is worth $1 million and it could sit on the market for 10 years, right? So what does that tell you? Is it worth it? No, because nobody's willing to pay it. So that's why you oftentimes see it. I laugh sometimes when, you know, again, we have people that come in and they're like, I'd like to buy this building, or, you know, but it's $10,000 or it's $100,000. And I go, been on the market for 4 years. Go make an offer. Don't make an offer for 5, but go make a reasonable offer because it's obvious that it's not. Now, what it comes into play with that is whether or not you can get a loan on it. If you have 100,000 cash and you're like, I can put 100,000 cash on it, but the fair market value is 75, I'm only going to give you 75. Why would I give you the 25 more? Because I need that 25, right? So these are the types of things that when you really start to lay it out and you start to look at it, you guys all know this, it's common sense to you. I mean, you guys have all said it, even as throughout the entire game, is like, why would I do that? But you're not used to it in the terms that we're talking about. And so what will happen is we'll play this again at the last class and we'll see where you guys are. We'll see how you feel. And I promise we'll do something other than paper clips. And we'll have enough. We'll get, did you? I know the first year, Arlene did it and I was like, oh, I know this. And she kept looking at my thing and she'd go, no, move, da, da, da. And I'm like, what? I'm supposed to teach this. What do you mean? So it just takes a while. No?
When you sell a business, so you sell the EIN number goes, they can change the name, they can do what they want with the business. If you're personally not. Oh, shit, okay.
Yeah, the EIN, you have to get an EIN.
Yeah, you get a new. Right, okay. No? The
Not if they
EIN
leave it the same,
follow the business?
because they're buying that business and the EIN. You change the registered agent.
Yeah.
You change the members. But yes, you are selling. So you're selling this business. So when you buy this business, number one, you're buying the name because the name has value, right? Somebody's taken the time. It's kind of like McDonald's, right? When you see those yellow arches, you know what it is. You see the crown, you know what that is. So you're buying recognition, brand value, so to speak. And so you want everything that comes with that business because that's what makes it. That's why most people don't change the name. And then you get all the equipment, you get everything that, right? So there is an element that's in there that's called blue sky, where I think that it's worth 100,000 and you go, it's only worth 75, that's all the bank. And then you and I kind of have to barter over that. And I've seen people do it. Nope, I'm not gonna give. I spent 10 years in the business, I deserve that 25. And you have to say, you know, yay or nay, but it's your 25. The bank's not gonna give it to you. They won't loan it to you. I actually had that happen with my mom with a business that she was looking at. And they said, it was really funny because it was a flower shop and it was like an iconic on the corner market, like, or on the corner like Anderson's and Sunflower Flats. You know, it was one of those, everybody drove by it all the time and they go, and plus we have inventory. And I go down in the basement to look at the inventory. It was inventory from 1935. And I'm like, I'd have to pay to get rid of it. No, it's not inventory. It was like the stuff for little girls and little boys, you know, the ceramics and like, yeah, it's like nobody wants it. That's why it's down there. And that was exactly, the bank said we won't loan on it. And my mom said, I'm not willing to be out of pocket 25, so she didn't buy it. So what this will do is we move into QuickBooks Online and we start working in the program. We're going to actually start doing those transactions that you saw in the profit and loss. We're going to book revenue. We're going to book expenses. You're going to start to, then we're going to look at the profit and loss and we're going to look at the balance sheet and you're going to go, okay, this is where all of these things are coming. And then I can make decisions based on my balance sheet, not on my profit and loss. Because my profit and loss is just what's happening this month. And let's say there was a flood. Let's say it was closed for an ice storm, right? It's going to be a bad month. But my balance sheet's going to show a prettier picture. All right, guys, any questions? So if you have not done homework from 1 to 5, I would encourage you to at least go in and just look at it. Take a guess. I'll talk with Jenny and see if she can get unlimited checks and balances on that. We will start being here at 4:30 and you're welcome. I say we, Leon's in the building too. So we're here if you need us. I will send out the link for the Zoom. So if you need to come in by Zoom, and then we'll make sure I put the slides in the chat. I forgot about the kind of the spur of the moment stuff, but we can get that to you as well. And then reach out if you need anything, and we're on next Monday. Apparently we're on through, there's no breaks through the rest of our time. So we're on every Monday. Mm-hmm. 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 Oh yeah, don't worry about it. I know Valentine's Day. I worked there during college, so yeah. Yeah. Valentine's Day and Mother's Day, you're just lucky if you're still standing. I would love to say that I would be that prepared. Yeah, or I'll email them. I'll email them. Yeah. Mm-hmm.
I was able to print my own.
The PowerPoint ones, or did you print them out of the book?
I printed them off of the web.
There you go. All right, so Jennifer, do you want to stop the recording and then we can log out? I don't want to